So when I joined RockCreek, we actually probably were not as well known as an OCIO. I think that term kind of just has evolved over the last 15, years. So really at that point, RockCreek was more of a multi-asset manager solutions. We had a lot of strategic partnerships with large institutional clients. And we really did research across every asset class and put together portfolios for those clients. And so when I joined RockCreek, it was about 2 billion in assets under management, about 20 people or 15 people. And today we're about 17 billion plus and, 50 plus people. So about 15 years ago, I helped start the outsourced CIO business. And that's where the majority of our capital is today. So we help endowments, foundations, pensions, family offices, smaller institutions that don't have internal investment teams. We are their investment team for all, intents and purposes.
I know that you attended Georgetown and you initially, I think, wanted to become a teacher. What drew you to the economics and the literature side? And where does that also show up in how you evaluate managers or communicate investment narratives today?
Oh, yeah, that's a great question. I never really connected the two. Yes, I did not know much about finance when I was applying to college. Didn't really know what I wanted to do, loved writing, so decided to major in English. And then, quite frankly, thought, okay, I do need to figure out some sort of career path. So added economics to that. So that was probably much less thought that young adults have put into the entire college effort today. But I went to Georgetown. I double majored in economics and English. And, I have always, again, loved to communicate, loved to through both writing on the English side, but also reading and just absorbing everything I could through reading. And I do think that it actually helps in my job today because being a portfolio manager, chief investment officer, talking to fund managers, everything that is related to asset management and allocating and an institutional allocator requires, a lot of, I think, more behavioral insights and communication and thinking about how the world works more than necessarily being in front of a spreadsheet. So I do think those skills probably help me today and have obviously been skills that I've continued to develop. I only decided to go into finance when I got an internship my junior year in investment banking. And I thought it would be really fun to go to New York, try something else out. Did a summer of kind of your typical investment banking. Back in those days, there were, I think, probably maybe 12 to 16 banks that were all hiring interns over the summer. And then when I came back to Georgetown at the start of my senior year, I got an offer from from the place that I had worked. And so that was kind of my entry point into finance.
And I know that you, again, started at Merrill Lynch, analyzing PE deals, and then you shifted more to Wolverine Trading, doing equity arbitrage. What was that transition like at that time?
Yeah, so I loved investment banking in that I learned a lot of good skills of I learned how to be really detail oriented. The first couple of months of investment banking training as a new analyst class, or at least back then, are really kind of the best practical experience of a day-to-day investment banker. And so you learn, DCF, balance sheet modeling, Excel skills, you learn kind of PowerPoint skills, you learn every single basic skill set that you need to kind of thrive in finance, either as an analyst or later on. And so I really enjoyed that part of investment banking. I think it is a excellent way to get an introduction into finance, even if you don't want to be an investment banker for the rest of your life, just because of the skills that you learn in terms of how to work in a professional business setting. That being said, because I worked at Merrill Lynch, I also saw a lot of the different parts of a bank, right? So even though I was on the investment banking side, I had friends in asset management. I had friends on the capital markets desk. I had friends across different sectors within investment banking. And so you really understand that when people say they want to go into finance, it can mean 1,000 different things. So I did my 2 years or a couple of years at investment banking, got a really good training ground. And then when I decided to move to Chicago, I did not look for other investment banking jobs because I really wanted to try something new within finance. And I knew there were a lot of different opportunities that I had obviously seen. I wasn't necessarily exposed to all of them, but I knew that finance was a lot greater than just doing investment banking. And so that's how I found Wolverine Trading. And then I really got into a totally different part of, the finance world by working at Wolverine Trading. At the time, they were one of the largest and still are one of the largest options market making firms. And they had just kind of finished moving people from the floor to more on electronic based system. So there was a lot of changes going on. And I worked at their hedge fund, which is an equity, which was at the time, I was more focused on their equity arbitrage strategies. They also had convertible arbitrage strategies, other strategies that were part of a general multi-strategy type model. And so I got to do everything from researching positions, trading, executing, using options to hedge some of our positions, and just got, again, a really good introduction to that side of the world and to hedge funds in general.
You joined RockCreek at around the mid 2000s as an outsourced CIO. What initially drew you into that early identity, and how did you focus and delegate your time to shape it?
Yeah, so when I joined RockCreek, we actually probably were not as well known as an OCIO. I think that term kind of just has evolved over the last 15 years. So when I started RockCreek, it wasn't really as big of a thing. So really at that point, RockCreek was more of a multi-asset manager solutions. We had a lot of strategic partnerships with large institutional clients. And we really did research across every asset class and put together portfolios for those clients. And so when I moved to Washington, again, I was looking for something in finance. I was open to continuing with a firm or a role like I had at Wolverine. But I also was introduced to the partners at RockCreek and really quite, attracted to the fact that they were small at the time. They were very entrepreneurial. They were really building their asset management firm from scratch. So it was a great opportunity, again, for a relatively young person to get to do all sorts of different areas within asset management because we were building a business versus just, a larger firm where I would have been really just stuck in one role. So when I joined RockCreek, it was about $2 billion in assets under management, about 20 people or 15 people. And today we're about 17 billion plus and, 50 plus people. So, and our business has evolved, as you said. So about 15 years ago, I helped start the outsourced CIO business. And that's where the majority of our capital is today. So we help endowments, foundations, pensions, family offices, smaller institutions that don't have internal investment teams. We are their investment team for all, intents and purposes. So we manage their portfolios across all asset classes.
How are you thinking about the right allocation to alternatives for a typical, say, endowment versus a pension fund client?
Yeah, no, that's a great question. So every client has very unique needs. And that really determines what type of allocation they should have to alternatives. And then within alternatives, what kind of alternatives, right, they can handle. So a lot of what we do when we first start working with an institution, whether it's a pension fund or whether it's a endowment or foundation, is learning what are their spending objectives, what are their risk tolerance, what is their tolerance around drawdown, what is the expected probability of keeping their annual spend consistent over time in the future. Will there be certain needs and circumstances that the organization might want to respond to, in which case that would require an increase in spend? That all also factors into, how do they feel about illiquidity in their portfolio? Committees, boards, institutions have a lot of preferences sometimes around these types of factors. And you really need to understand all of these and also the priorities of the organization to be able to understand how much they can have in alternatives, because no matter what type of alternative, the vast majority are going to have some sort of illiquidity relative to public equities, right? So even though hedge funds there's a lot of liquid hedge funds, they're still going to be less liquid than your typical, investment in a passive instrument or a mutual fund. And so we try to really understand what the objectives are of an institution. And then from there, I'll build an asset class, asset allocation, a long-term strategy that can be our guidepost, our framework for how we manage the portfolio, but also an asset allocation that's going to deliver on the return objectives that the institution needs to be able to meet their spending objectives.
I want to kind of jump into that liquidity structure there. I know it's like you mainly do 3 tiers. I think like roughly 5 to 10% go to high, again, 40, 60 moderate, and then 30, 40% mostly illiquid. If we go back to 2022, when public markets were and bonds fell, and also private distributions like slowed. What did that actually look like, and how did you manage those types of cycles?
Right. You said 2022, right?
Yeah.
Now I'm laughing because, a lot of investors, committee members, boards, investors forget that 2022 was a down year, right? Because we've had such a strong last couple of years. Markets continue to go up no matter what's going on in the world, what's going on anywhere. And 2022 was a really bad year for public equities. It was down 22%. But your
Yeah.
privates really were holding up. And so, that year, our returns looked fairly good because we had really strong returns from our private markets. Fast forward 2023, that's when private markets started to really mark down. They started to obviously catch up to where public markets had been in 2022, but then public markets had rebounded. So, as an investor, you really have to timing is everything, or thinking about your time horizon with private equity and illiquid alternatives is everything. And if you don't understand that cycle, it's going to be really difficult to manage a portfolio because you're going to usually make decisions at the wrong time in the cycle. So, it was a lot of education in terms of this is why public markets are doing what they're doing, and this is what private markets are doing what they're doing, right? And trying to kind of make sure people understand the role of both private markets and public markets in your portfolio and why there is this disconnect and this lag when you look at valuations and when you look at the market. Same thing is happening now, right? This coming up third quarter is going to be one of our best quarters in the last couple of years in terms of our private portfolio. We just have a number of portfolio companies that have really been poised to hit either the IPO market or have had a lot of significant events that are going to end up marking up their valuation. We're not going to see that until third quarter, which means that when an investor looks at their report, they're not going to see that till the fourth quarter. So there's just this constant lag when you look at privates, which is why we really believe you have to have a very long-term time horizon to judge whether your private markets portfolio is really adding value and the type of value that you expect.
I know you've expressed also a lot of optimism to healthcare and biotech IPO markets. Potentially reopening. Are you adding life sciences commitments? Is that a sector you're actively deploying at the moment?
Yeah, that's a great question. So it has turned into one of the better years for biotech, right? On the public market side, some of our investments in the biotech side, on the venture side in particular, so in the private market space, are fairly new. So it's going to take time. The life cycle for a biotech venture is probably, I would say, pushed out even further than kind of your traditional software or consumer tech type portfolio companies. And so you have to be patient. That being said, we have a lot of exciting portfolio companies that are going to be focused on, things like GLPs and, Alzheimer's and just the whole cancer. I mean, one of our funds is focused specifically just on oncology. And, that is one of the biggest killers in the US in terms of diseases. And so it's an area that has had a lot of investment and will continue to have more investment. So, we really do look for kind of more niche areas to invest in where there is an edge in terms of how they think about sourcing, how they think about also sometimes rolling up some of their portfolio companies to create new portfolio companies and being just a little bit more opportunistic in the private space. I think the public space will be interesting. There's been one or two big biotech announcements in terms of phase 3 trials. One company went from, I think a $10 to a $70 stock overnight after their phase 3 results came out. And it just goes to show you the volatility of being a public markets investor in biotech.
Definitely. It's a very risky market. I know you also do a lot of co-investments, and same applied to the biospace. If you invest into Devoted Health, BioH Labs, how do you split that direct investing versus the co-investments?
Yes, that's a great question. So if you look at our total private equity exposure in a typical portfolio, we'll probably have around up to 10% in co-investments and directs. We're not going to do every single co-investment that our private equity funds come and give us. We're not a programmatic investor on the co-investment side like that, because we do have a direct team ourselves that can do the work and kind of do more of the diligence than just taking every co-investment that we get. And so we do find a lot of value in co-investments and directs, but we really do tend to have them be also very kind of more mission aligned with our particular organizations for those that kind of want to focus on that. So for example, if we have a organization, a foundation that's very focused on childhood education or education in general, we're going to be looking for companies in both the co-investment and direct space that are going to be more tied to that sector or that theme. So that's why we tend to be a lot more thematic in our co-investments and directs.
I saw that the Connecticut's pension has worked with RockCreek for around 15 plus years now on emerging manager programs. How has that relationship evolved as the program has scaled?
Yeah, no, they're a great partner, and they really truly believe in the value of investing in emerging managers. And I think that's one of the reasons that they've partnered with RockCreek, regardless of the asset class. And this is just something that RockCreek has also done from day one. We've always believed that having a diversified portfolio is extremely important, whether it's diversification within an asset class or across the total portfolio. And one of the ways that you get that diversification is also by having managers with different perspectives, right? And so also managers that are different, phases of their own life cycle. So we have relationships with established managers, but we also have relationships with emerging managers. And we find that they add a lot of value in terms of really bringing a different perspective, and I think in general, just how they are thinking, starting today, a firm focused on life sciences is very different than starting it 20 years ago. And so having that mix of perspectives, we've had a lot of success with our emerging managers. And, it's getting harder and harder, especially on the private side, I would say. We've seen it's getting harder and harder for fundraising for a fund one, but it's also really hard for fundraising for a fund two, because most of those fund twos were fundraising during that 2021, 2022 period where everybody was allocating and then everybody dried up, right? A lot of institutional investors started to really pull back. And so we've seen for some of our emerging managers that we had relationships with and are in their fund one, coming back for fund two has been a much more difficult fundraising environment.
Even though that time period wasn't as the best for fund ones and fund twos, where did you see certain funds excel during that period? What were the kind of strategies they implemented to set them apart?
Yeah, I think like being able to really show kind of value add to their portfolio companies, right? How did they help the portfolio companies navigate through challenging times? Was there a lot of good assistance in terms of how to manage cash, when to come back to market for those portfolio companies, right? When do they need to raise more cash? We did a lot of digging in terms of how did they, assist portfolio companies through some more of the challenging times that we've had. We also have seen, some success, not as much in terms of early kind of wins on the DPI side and, distributions, realizations. That's not a given for a fund that's so early in their life, but that has also been something that obviously is great for a fund one that's going to raise money for a fund two to be able to talk about.
We've also co-authored research with IFC on the gender balance in private equity. How does also that research inform your changes in how you also source and evaluate managers today?
Yeah, that was a great study that we did about, I want to say maybe 5 years ago, maybe a little bit longer. And it was focused on emerging markets in particular, and it was focused on private equity and venture capital within emerging markets. But if you take a lot of those takeaways, they're actually, they look even worse for developed markets or for the US. So there's even less gender balance actually in some of the data that we've seen on the US side or the developed market side. I think that it was great to do that study and have it reinforce a lot of the more subjective takeaways that we already had. So we have always seen, and this goes back to kind of emerging managers or managers with more balanced teams, we've always seen that, yes, they bring a very different perspective sometimes, and they have different viewpoints and perspectives than just kind of the consensus, but that also their portfolio companies and the portfolio companies that they're investing in also tend to have more balanced teams or have different perspectives and have different viewpoints. And again, we think all of that just adds to greater return. So we are looking for the best investments. We're looking for the best managers, the best portfolio company founders, and having, again, more balance, more diversity, more perspective, more just, differences in terms of where people have, experience has all helped generate more value in our portfolios.
When you're looking at returns specifically, I know we just mentioned life sciences, more the biotech space. Are there any other sectors or investment themes you're actively looking at the moment or focusing on?
Fintech continues to be a really exciting space. There's a lot of need, especially, we live in a society where there's definitely kind of a growing divergence between, those who are able to access financial products and those that have more difficulty accessing financial products. And so we have seen a plethora of different types of fintech funds that are investing in portfolio companies that try to tackle those different issues in all different ways, right? Whether it's credit score or whether it's education or access to different financial products, that allow them to save more, or, student loans, or there's just a whole host of areas within fintech. And, having worked in finance for 25 years, I do think that finance is probably not as has not always been as innovative. And so now there's all these new AI tools and things that can be applied to how financial firms are doing things. And so these fintech firms have really helped, I think, start that area, even with like more established banks that are now wanting to do the things that fintech companies are doing, right? So it's like this entire ecosystem that has, I think, a lot of room to grow. So we've been investing quite a bit in those areas. Other areas besides healthcare, middle market buyout has been really interesting in terms of industrial, in terms of really, thinking about just your basic kind of accounting firm and a roll up of an accounting firm, a roll up of accounting firms, and how can AI tools help make that such a much more efficient process. I mean, if you look at so many different sectors kind of in that middle market buyout space, and if you think about even just one example of how AI can really, or introducing new AI tools to those types of companies can improve efficiency and help them grow, I think there's a huge opportunity there. We obviously, I mentioned AI several times, but there's a lot both in terms of AI infrastructure that we're doing, as well as in terms of consumer applications that we're looking at and that we have in our portfolio. All have done quite well. We have, investments in just a whole host and range of companies that are going to really, I think, be the future of how we think about AI. And so that's been a really exciting place in the portfolio as well. So much to do in the venture and, I would say middle market buyout space in particular that we're excited about. And I do think that with more companies staying private, there's probably just going to be increased opportunities on the private market side. And so even if you don't have a ton of private exposure, having some, if you can take the illiquidity, just gives you, again, a huge diversification and a huge opportunity for investing that you do not get if you are just in the public markets.
Yes, I know Ian, private markets had a massive denominator effects in like 2022, 2023. How do you also think about just committing pacing and also just construction at that level as well?
Yeah, we always say it's more art than science because we have our pacing models and we have all our assumptions. And like, if you stuck to those assumptions over the last couple of years, hoping that things normalized, you probably have a really wacky portfolio today. And so you have to also, I think, be very mindful and flexible of the environment that you're seeing and kind of being responsive to that as well. So we changed our assumptions on how fast we were going to get distributions back. We changed our assumptions on how fast capital was going to be called. And so that impacted how much our annual commitment budget was. And again, it's more art than science. We're not going to force it just because we have a number for a year. That's our target. If we don't have top quartile funds coming back to market that we like, we're not going to allocate. We're fine being under and we're fine being a little bit over, depending on what the opportunity set is. It's really also about what kind of quality fund are you investing in, and then what theme or sector do you really want to be in, and being able to size that appropriately over the next couple of funds. Our goal is not just to be in one fund for a relationship. We want to think about that relationship over multiple funds, and that means thinking about sizing the portfolio in a way that allows you to pace that and allows you to have a total relationship that's meaningful but not oversized in your portfolio.
You've been at RockCreek for roughly 20 years now, and you've also now reached this Co-CIO level. What does that next chapter look for you, but also the firm in itself?
Yeah, I think it's a great question. We continue to grow steady. We really love working with endowments, foundations, pensions, family offices. That's really our bread and butter. So we have never, we're not, looking in terms of expanding outside of that institutional strategy. That's really where our focus is and where we can deliver the best investment returns. And so I think we'll definitely continue to see how can we help our clients really deliver on their mission. They do such amazing work in their communities and across areas like healthcare and education and, financial inclusion, equity, justice. And so there's just a lot of different areas that they're working on. And the more we can deliver a steady return for them from their investment portfolio, the more they can do, right, in perpetuity. Because we always think about the long term. Organizations are around for the long term and are wanting to build a portfolio that can sustain them. And so I think for RockCreek, it's really continuing to deliver on that. And then also really continuing to be innovative. I mean, within RockCreek, we have a technology platform that allows us to manage our portfolios, as well as source investments and put it all together and then implement. And we developed this technology platform day one of RockCreek before we even had a client. Today it's on, version 10.0, call it, and it can do so much because we have all the data from the last 25 years of investing. And we also have all these new AI tools that we can apply to that data, right? Because AI tools are irrelevant if you don't have data to apply them to. And so what we can do now in terms of analysis, in terms of efficiency, in terms of, quality is just, very different than what you could do 20 years ago. And so all of that, I think, will help make our portfolios, just even better in terms of delivering returns and also being positioned well in times when markets are going to go down.
Yeah, it's exceptional. And again, the capabilities in today's age is marvelous. So thank you so much, Alifia, for coming on. It's exciting to see where RockCreek goes and innovation continues.
Yes, thank you so much for having me.